So welcome to the UK Capital Gains Tax Calculator. Now this calculator will help you to understand what your CGT liability is, but it will also help you to understand how you can reduce that liability as well. So what I've done for you is given you a spreadsheet. Now you can read the assumptions, the purpose and disclaimers right there, and you can click on this video. Now the fact that you're watching this video, well, to be fair, you don't need to click on that. You're already watching me. In this workbook, you will be able to enter any cells where it's got this blue highlight right there. But any cells that have got a gold trim around it and white, then please do not make any changes there because it's all formula driven. Now, if you are using this spreadsheet and you paid for it at $9.95, then why not go to our Teachable platform? There is a 7-day free trial. There are a bunch of other tax calculators, videos to help you reduce your tax liabilities. And I'm live every Wednesday to take your tax questions and answer them in the best way possible. So let's go ahead now and talk about CGT. So what we've done is got a couple of sections here. We've got sections about you, about the property, and then we move down to the tax position. And then further, we'll look at how to reduce CGT altogether. So let's go ahead now and type in, now this will assume, and when we talk about you, that you're a couple. Now you could be a single person and that's absolutely fine, but you could be a couple as well. So let's imagine, and we are going to take it on the basis of someone who is a high rate taxpayer because this really is a sweet spot. So let's imagine we've got, we'll go with Sarah. And we've got John as well. Now, we need to enter the details. So Sarah is a high rate taxpayer. She's earning £45,000 worth of income per year. And John is working full-time in property, earning just £15,000. I say just, but you know what I mean. Now, you've got CGT losses. If you have CGT losses, you can carry those forward. And it does bring down your capital gains tax liability, because your gain that you're going to be taxed on is reduced by those losses that you carry forward. So make sure that you go back to your tax return and dig that loss out. Don't forget that each person has a CGT annual allowance of £12,300. So it's really important, if you own the property, like in this example, whereby it's just in one person's name, that we want to utilize the other person's CGT allowance. I'll go through an example later on about that. We'll talk about the property itself. So we'll talk about 123 Main Road. And what we're going to do is percentage share. Now, we did say that we're going to have this as Sarah owns 100% of the property and John doesn't own anything at all. And this will really help us with this example to show you how we can reduce the tax liability. In most cases, you may have 50-50 ownership. Now the purchase date we'll just put in here is unlikely, but we'll go with the 1st of 2000. Who would buy property on the 1st, let's be fair. And then the sold date. So if we put in the 31st of 12/2021, that will tell you now that there's a number here of 8035. That is the number of days that the property has been owned. Now, the interesting thing, it's red, which tells you that there's something missing or wrong. And what's missing or wrong is the days in here. So we've got a couple of days split now. So you need to enter the details as follows. The number of days that you lived in the property. That's really an important number of days because you will get private residency relief, which means that you do not pay tax for the time you've lived in the property. There are so many tax advantages for you to have this PR moving back into the property to extend that private residence relief in order for you to reduce your CGT liability. Since the 5th, let's get the dates right, 6th of April 2021, the capital gains tax law has changed where lettings relief has been removed if you have not lived in the property at the same time as the tenant. So typically you will find people that have purchased a home, they've vacated that property, moved a tenant in, and years gone by, you could get capital gains tax lettings relief. Unfortunately, those times have gone. You can only get that relief now if you've lived in the property at the same time with the tenant. Well, that's mostly unlikely, and anyway, why would you not just put in the days lived in because you will get private residency relief anyway. Well, it's just the fact that it extends, it gives you extra allowances. But for most people, you would have this time of living in the property and then renting it out. And then finally, you've got the days that the property was empty. So there's no relief for that either. Now, you may think, well, how do I work out all this? Well, I've created a template here called days count, and you can put in here days lived in the property. So what we're going to do is make sure we've got the 1st of the 1st, 2000. So I want you to enter that detail there. So 1st of the 1st, 2000. And what we're going to say is that we lived in the property for a period of time. Now, we sold it in 2021, at the end of 2021. So we want to say, well, we lived in the property until the 31st of December 2018, as an example. Now, I've messed things up here, so let me just try that again. So what? There we go. So this now tells me the days, 6939. So it just helps me to understand how to put numbers together. So this is a quick calculator to stop you from having to get the manual calculator out and get those days. So 6939 is the days that we lived in that property. So we'll put that in here. And what we want to do is then for the remaining period of time, we'll say it was let out, but I did not live with the tenant. So we'll say it's 8035 minus the 6939. So that tells us now, and you'll notice that all the red pieces have gone, which means that the day split now agrees to the days owned. So that's really important. If you've got red, there is a problem. You need to resolve it, and you just need to tweak with these numbers here. So what we'll do is we'll put a sales price. So let's imagine we sold the property for £450,000. And what we'll say is the sales fees, maybe it's £5,000. Oops. And what we've got here is the purchase price. Now, this is really important to understand, because if you vacated the UK, you can get an adjusted price. So if you bought a property in 2010, which is in the year 2000, as it says here, no doubt that in 2015, the property price would have increased. So if you've left the UK, you could actually use the price on the date of the 5th of April, 2015. So the value, the purchase price, would actually be increased, even though you actually purchased it for much less. So if you have left the UK and you want to have this adjusted price, then you do need to get a RICS valuer to give you the date of the value the property was then, and probably work with a specialist like ourselves to help you work with this spreadsheet. But for our purpose, what we'll say is we've stayed in the UK and we purchased the property for £200,000. The purchase fees, let's say, is 500, and we've got some stamp duty, and I'm not going to work it out, but let's imagine it's 1,500. We may have some refurb costs, so you may have some costs which you put against your property income when you refurbish the property. And that's great from an income tax purpose, but you can't have your cake and eat it. So if you've claimed those costs against your tax return already, you can't use those costs here. So we'll put in 0. Now, if you didn't put your refurbishment costs against your property income, which why not? Because you would have got a 40% tax relief as a high rate taxpayer. But you then said, well, actually, we'll keep those costs for when you sell the property. And an example here would be if you extended that property. So if you put in an extra bedroom, or indeed you extended the living room space, bedroom space, whatever else, then those costs would be capital in nature anyway. So that number would go in here. And actually, we'll just put in £25,000, because so that will reduce our taxable gain. Now, what will happen is it will give us now the total costs of buying, refurbing the property. We've also got now the taxable profit of £218,000. Now, one thing you'll notice is that we've already said that Sarah owns all of the property. John has no ownership at this time whatsoever. So Sarah is the only person who's going to be subject to CGT. And hark, you're probably thinking, why? That's a mess, or it doesn't relate to me. Don't worry, because you can put your percentage splits right at the top here, and that's fine. But I want to show you the power of this spreadsheet in order to reduce capital gains tax liabilities. So one thing you should see is that we get less private residency relief of £195,000 for the time that Sarah lived in the property. And don't forget, you'd get this extra 9 months PRR as well. This spreadsheet does that calculation for you, so you don't need to. Now, what it does mean, though, is that we've got the situation whereby the taxable profit is now 22,000 less the CGT allowance of 12,300 gives a property taxable gain now of £10,000, which would be subject to a basic rate tax ban because you have earnings up to £50,000. Don't forget, once you go over £50,000, as in total taxable income, then you hit the high rate tax ban. So here we've got a situation whereby Sarah has got a tax liability of 2301, and this would typically have to be reported to HMRC within 30 days of disposal, which is completion date, not exchange date. But we don't want to do that, and that's where this spreadsheet would really help you to reduce your tax liability, because you're saying, well, the property was owned 100%, but I really want to utilize the CGT annual allowances for John. So why don't I tweak around with these numbers? And that's easy to do. So what we could say is, well, hold on a minute. We know that John's a high rate, it's a basic rate taxpayer. Sarah is a high rate taxpayer. Why not change the percentages? All right, let's go ahead and do that. So what we'll do is we'll change this percentage. So it's actually now, let's just put in here 50% and 50%. Sorry, that's what I should have done. So 50%, 50%. So does that now change the tax liability? Well, it sure does. And the reason for that is because we've now utilized the 2 annual CGT allowances, which basically means there's no gain at all, no taxable gain, and there's no tax to pay, which also means that there is no CGT reporting requirements by you because you've not made a gain. Actually, it's 0. So there's no CGT reporting within 30 days. Now, what you need to do is use a deed of trust. So a deed of trust is something that your solicitor will do to say, I'm transferring my share or an element of my share, in this case 50%, over to my spouse. And for tax purposes, that is great because all of a sudden now we've been able to reduce that tax liability. So the fact that we've had this initially 100% and 0%, and Sarah had a tax liability, let me just correct that back to what it was. You can see there is 2301. But because we've now used the deed of trust, we've now reduced that 2301 down to 0 using a deed of trust. Now, don't forget that there are so many ways in which that you can reduce your tax liability. We've talked about using a deed of trust. There's a video and an article for that, but there are other ways of reducing their CGT liability as well, and those links and videos are contained in this workbook. So not only are we looking to help you calculate your CGT liability, but we're also demonstrating how easy it is to reduce that CGT liability as well. Hopefully this has been useful for you, and I hope that it will help you reduce your CGT liability as well when you're selling any of your buy-to-let properties. My name is Simon Misiewicz from Optimise. I shall see you on the next video.